They're doing it again, right on schedule, like clockwork, like a machine programmed to shake you out of your position at the exact moment when you should be holding tighter than ever. $6.8 billion. That is the number. That is the ammunition they have loaded into the chamber. That is the calculated, coordinated, manufactured selling pressure that Wall Street is about to unleash on the silver market over the next few days. And they are praying, they are hoping, they are betting their bonuses that you will panic, that you will see the red candles, that you will watch the price drop 5%, 6%, maybe 7%. And you will do exactly what they want you to do. You will sell your silver into their waiting hands at a discount. Do not give them that satisfaction. Do not be their exit liquidity. Because what is happening right now is not a market event. It is a heist, and you are the target. Let me explain exactly what is unfolding. Because if you understand the mechanics of this manufactured sell-off, you will not only avoid the trap, you will use it to your advantage. Every January, the major commodity indexes go through what they call a rebalancing. The Bloomberg Commodity Index, the S&P GSE, and others adjust their weightings based on the previous year's performance. Sounds boring, right? Sounds like routine administrative housekeeping. That is exactly what they want you to think. But here is what actually happens during a rebalancing. Passive funds, the massive institutional pools of capital that track these indexes, are forced to buy or sell futures contracts to match the new weightings. And after a year like 2025, where gold had its best performance since 1979, where silver exploded higher by triple digits, the indexes are now overweight precious metals. The rebalancing requires selling, lots of selling. According to Citigroup, approximately $6.8 billion worth of silver futures will be sold to meet the new index requirements. Let me put that in perspective. That represents 12% of the total open interest on the COMEX. 12% in a matter of days, dumped onto the market, not because anyone thinks silver is overvalued, not because the fundamentals have changed, not because the supply crisis has been resolved. No, dumped because a spreadsheet says the index weights need to change. This is the absurdity of modern financial markets. This is the tail wagging the dog. Billions of dollars of selling pressure created by a mathematical formula, executed by algorithms, with zero regard for the actual supply and demand dynamics of the physical metal, and silver, being a smaller and more volatile market than gold, is disproportionately affected. Citigroup explicitly stated that silver is more susceptible to index rebalancing than gold. The selling is concentrated, the impact is magnified, the price action is violent. We already saw the first wave. Silver dropped nearly 4% in one session, then it fell another 5.5%. Silver-backed ETFs experienced their largest single-day withdrawal since October. The headlines screamed that silver was collapsing. The financial media gleefully reported the decline, subtly implying that the rally was over, that the top was in, that anyone still holding was a fool. This is the script. This is how they operate. Create a manufactured sell-off through structural mechanics that have nothing to do with fundamentals. Amplify the fear through media coverage. Shake out the weak hands, accumulate at lower prices. Then let the fundamentals reassert themselves and ride the next leg higher. JPMorgan Chase, in a note dated December 12th, explicitly acknowledged that this year's silver selling during the rebalancing would be greater than last year's. They know, they are preparing, and I guarantee you they are not selling their own silver. They are waiting for you to sell yours. But zoom out, look at the bigger picture. What happened in the first full trading week of 2026 before this rebalancing sell-off began? Spot gold climbed over 4%. It added more than $177 in a single week. Spot silver surged nearly 10%, adding over $7 per ounce. Wall Street saw a synchronized rise across various asset classes. This is what terrifies them. This is why the rebalancing feels less like routine maintenance and more like a desperate intervention. The precious metals market was running away from them. It was breaking out. It was attracting attention. And attention is dangerous when you are trying to accumulate a position in a market with structural supply deficits. So here comes the rebalancing. Here comes the $6.8 billion of forced selling. Here comes the manufactured correction that knocks the price down 10% and scares the retail investor into capitulating. But look at what is driving the rally. Look at the fundamentals that no amount of index rebalancing can change. Geopolitical instability is not going away. It is intensifying. Every week brings new headlines. About conflict, about sanctions, about supply chain disruptions. Safe haven demand for precious metals is structural, not speculative. The world is uncertain, and uncertainty drives capital into gold and silver. The Federal Reserve is signaling a shift. The market is watching every word from Fed officials this week. Bostic, Barkin, Williams, Kashkari, and others are scheduled to speak. Their tone will move markets, and the expectation, the whisper on trading floors, is that the Fed is preparing to cut rates. A softer jobs report on Friday could accelerate those expectations. What happens when the Fed cuts rates? The opportunity cost of holding non-yielding assets like gold and silver decreases. The dollar weakens and precious metals become more attractive to every investor on the planet. The rally that took silver up 171% in 2025 was powered by exactly these dynamics, and those dynamics have not changed. They have strengthened. The US dollar is weakening. This is the silent driver that the mainstream media barely mentions. A weaker dollar makes gold and silver cheaper for buyers in other currencies. It expands the global demand base. It provides fundamental support that transcends any temporary rebalancing pressure. Central banks are still buying. The record purchases that defined 2024 and 2025 are continuing. Sovereign wealth funds are accumulating. The de-dollarization trend is accelerating. Official sector demand is providing a floor under the precious metals market that did not exist a decade ago. And the supply crisis? Still here, still intensifying. The 70% drawdown in Western vault inventories has not reversed. China's export restrictions have not been lifted. The structural deficit between industrial demand and mining supply has not been resolved. Nothing about the physical market has changed except that prices are temporarily lower due to a manufactured paper sell-off. This is the opportunity. This is the gift. The market is handing you a discount created entirely by index mechanics and passive fund flows. The fundamentals are screaming buy while the algorithms are forcing sell. Now, I am not telling you this will be comfortable. I am not telling you the price cannot go lower in the short term. The rebalancing selling will continue through. Early next week, the volatility will be intense. You will see days where silver drops 3%, 4%, maybe 5%. You will feel the urge to sell. You will question your thesis. Do not let temporary paper price movements shake you out of a position backed by permanent physical reality. The December CPI release on Tuesday could move markets in either direction. A hot print might temporarily strengthen the dollar and pressure metals. A soft print could accelerate rate cut expectations and send metals higher. Either way, the data will create volatility. Either way, the fundamentals remain intact. Throughout the week, economic data will roll in. Retail sales, PPI, import prices, jobless claims, the beige book. Each release is an opportunity for the market to overreact, for algorithms to trigger stops, for weak hands to capitulate, and each overreaction is an opportunity for you to accumulate at better prices. The smart money understands this. The institutions that are publicly warning about the rebalancing are privately preparing to buy the dip. They are not reducing exposure to precious metals. They are waiting for the selling pressure to exhaust itself, for the passive funds to finish their mechanical adjustments, and then they are stepping in to accumulate. JPMorgan noted that last year's similar index sell-off did not significantly impact the market over the medium term. The selling came, the selling went, and the price resumed its uptrend. This year will be no different. The mechanics are the same. The playbook is the same. Only the scale is larger because the previous year's gains were larger. Think about what that means. The rebalancing selling is proportional to the rally. A bigger rally means bigger rebalancing. A bigger rebalancing means a bigger temporary dip. A bigger temporary dip means a bigger buying opportunity for those who understand what is happening. This is not complicated. This is not mysterious. This is not some unfathomable market dynamic that only Wall Street insiders can understand. This is a scheduled, predictable, mechanical process that happens every January. And every January, it creates a temporary dislocation between price and value. The price is what you pay. The value is what you get. Right now, the price is being artificially suppressed by $6.8 billion of index-driven selling. But the value of silver, the true value based on supply deficits, industrial demand, monetary debasement, and geopolitical uncertainty, has not changed. When the selling exhausts itself, when the passive funds finish their mechanical adjustments, the price will snap back to reflect value. And if history is any guide, it will overshoot the rubber band effect. Compressed prices followed by explosive rallies. We saw it last year. We saw silver surge from the post-rebalancing lows to new highs within weeks. We will see it again this year. The only question is whether you will be positioned to benefit or whether you will have sold at the bottom, exactly as they wanted you to. The $6.8 billion is not a signal of weakness. It is a signal of desperation. It is the establishment using every mechanical tool at their disposal to create selling pressure in a market that fundamentally wants to go higher. And mechanical tools have limits. They run out, the selling ends, and then the market remembers why silver was rallying in the first place. So watch the CPI, watch the Fed speeches, watch the jobs report, watch the daily price action and understand what you are seeing. You are seeing a manufactured shakeout designed to transfer wealth. From weak hands to strong hands, do not be a weak hand. Do not let a spreadsheet adjustment in some index committee shake you out of the greatest precious metals bull market of your lifetime. The rebalancing is temporary. The supply crisis is permanent. The dollar debasement is permanent. The geopolitical instability is permanent. When this week is over, when the selling pressure has passed, silver will resume its march higher. And those who held through the volatility, those who added to their positions at artificially suppressed prices, will be rewarded. The $6.8 billion dump is their last desperate play before the next leg of the rally. Do not fall for it. Do not give them your silver. Hold the line by the dip, and remember that every ounce of physical metal you own is worth more than any paper contract they can sell. This is the shakeout. This is the trap. And this is your opportunity. See you in the next video. Keep stacking.